Hey everyone, welcome back to Corporate Decoder, the place where we help you make sense of all the financial jargon. Today we're diving deep into Perella Weinberg Partners' latest quarterly report, and let me tell you, this one has some interesting numbers to unpack, especially when it comes to how the company is performing and what their future might hold. It is a real mixed bag, and we're going to break it all down for you. Also, if you are keen on getting straightforward insights from these complex financial documents and want to join a community of like-minded individuals, make sure you are subscribed and check out our Discord link in the description below. Alright, let's jump right into this 10Q report from Perella Weinberg Partners, or PWP as we'll call them. This is their quarterly report for the period ending the 30th of September 2025. This company, PWP, is a global independent advisory firm. Think investment banking, but specialized. They advise on things like mergers and acquisitions, strategic advice to companies, and helping them raise capital. They're basically matchmakers for big financial deals. Let's look at where they stand financially. On the 30th of September 2025, their total assets were $650.2 million. That is down from $876.8 million at the end of 2024. So a bit of a shrinking in overall assets. Their cash situation has significantly changed. They had $331.6 million in cash and cash equivalents at the end of last year, but that dropped to $185.5 million by the 30th of September 2025. That's a big chunk of cash gone. Now, accounts receivable, that's the money clients owe them. This also went down from $73.3 million at the end of 2024 to $40.7 million by the 30th of September 2025. This could mean they've collected more on what clients owe, or maybe fewer deals are pending where they'd be waiting on payments. Their total liabilities also decreased from $647 million at the end of 2024 to $449.7 million by the 30th of September 2025. That is a good sign, meaning they owe less money. But here is where things get interesting. Their total equity is $302.4 million in the negative as of the 30th of September 2025. This is a substantial accumulated deficit. This means that overall the company owes more than it owns in terms of its equity. It's a bit like owing more on your mortgage than your house is worth. But on a corporate scale, this has actually improved though, as at the 31st of December 2024, their equity was in the negative by $421.4 million. So that is a positive shift, but still a significant deficit. Now, let's talk about how they're making money, or in this case, how they've been performing in terms of profit and loss. For the 3 months ending the 30th of September 2025, their revenues were $164.6 million. That is a significant drop from $278.2 million in the same period last year. That is a 41% decrease. Looking at the 9 months ending the 30th of September 2025, their revenues were $531.7 million, down from $652.4 million in the same period of 2024. That's an 18% decrease. This signals a tough period for deal making. Let's look at their expenses, specifically compensation and benefits. For the 3 months ending the 30th of September 2025, these costs were $116.3 million, a big drop from $202.3 million last year. That is a 42% decrease. This makes sense because their revenues are down. When the company makes less money, they tend to spend less on salaries and bonuses. For the 9 months ending the 30th of September 2025, compensation and benefits were $373.9 million, also down significantly from $628.2 million in 2024. That is a 40% decrease. A large part of this decrease in the prior year was due to something called the vesting acceleration of professional partners awards, which led to a hefty expense back then that didn't repeat this year. Their non-compensation expenses, which include things like professional fees, technology, and rent, really stayed pretty flat for the 3 months ending the 30th of September 2025. They were $39.4 million, only a slight 2% decrease from $40 million last year. For the 9 months, they actually increased slightly by 3% to $128.4 million from $124.1 million. This is important because it shows that while they're cutting down on compensation in line with lower revenues, their other operating costs are stable or even creeping up slightly. All of this combined means their operating income has taken a hit. For the 3 months ending the 30th of September 2025, operating income was $8.9 million, a sharp drop from $35.9 million in the same period of 2024. That's a 75% decrease. And for the 9 months, they reported an operating income of $29.5 million. a huge turnaround from an operating loss of $99.9 million last year. This is a critical improvement, showing they managed to turn things around from a big loss to a profit in the first 9 months. Which brings us to the bottom line. Net income attributable to Perella Weinberg Partners was $6.0 million for the 3 months ending the 30th of September 2025. That's a 63% decrease from $16.4 million in the same period of 2024. However, for the 9 months ending the 30th of September 2025, they reported a net income of $26.1 million, a massive improvement from a net loss of $85.5 million in the prior year. This shows the company is moving in the right direction financially over the longer term period. Let's quickly look at their cash flow. For the 9 months ending the 30th of September 2025, their operating activities resulted in a net cash outflow of $61.2 million. This means more cash went out than came in from their core business operations. This is largely due to paying out bonuses from previous years and other operating expenses. In contrast, for the same period in 2024, operating activities provided a net cash inflow of $83.9 million. This difference is significant. It suggests the way they are generating cash from their business operations has weakened. Their financing activities for the 9 months ending the 30th of September 2025 show a net cash outflow of $162.6 million. This is mainly due to paying taxes on vested stock awards, settling cash exchanges of their OpCo units, buying back their own stock, and paying dividends. In 2024, the financing activities also had a net outflow, but it was smaller at $74.4 million, largely because they had received proceeds from issuing stock. Speaking of share repurchases, they have a program to buy back up to $200 million of their class of common stock. As of the 30th of September 2025, they still had about $60.2 million of that authorization left. They did buy back some shares in the third quarter of 2025, but it was a small amount compared to the total authorization. Now, here's a look at their client numbers, which directly impacts their revenue. For the 3 months ending the 30th of September 2025, they had 56 advisory clients, a substantial drop from 97 in the same period of 2024. That is a 41% decrease. The 9-month figures also show a decline, with 135 clients in 2025 compared to 176 in 2024. This client reduction likely explains a big part of their revenue drop. Similarly, the number of clients paying them over $1 million also decreased. For the 3 months, it dropped from 43 in 2024 to 28 in 2025. For the 9 months, it went from 107 clients in 2024 to 93 in 2025. Both are significant decreases. Geographically, the United States still makes up the bulk of their business in terms of revenue. For the 3 months ending the 30th of September 2025, US revenue was $123.5 million, down from $253.7 million last year. International revenue also saw a large drop. Within the notes, a few things stand out. They've adopted new accounting pronouncements on income tax disclosures and expense disaggregation, which are mostly about making their financial reporting clearer. And here is some news that happened right after the reporting period ended. On the 1st of October 2025, they acquired Devon Park Advisors, LLC. This is an advisory firm focused on specific niche areas like secondaries in the investment world. This acquisition cost them $20 million in cash plus shares of their class of common stock. This is a strategic move to expand their services. Also, on the 5th of November 2025, they declared a cash dividend of $0.07 per S-share. This shows they are trying to return value to shareholders even as the company navigates these challenging financial waters. So, what is the story here? Perella Weinberg Partners is in a bit of a tough spot with declining revenues and a significant drop in clients. This is a direct reflection of the current market for mergers and acquisitions and other advisory services, which can be very volatile. They've managed to cut costs, especially compensation expenses, which has helped them move from a net loss to a net profit over the first 9 months of the year. However, the significant accumulated deficit in their equity is a concern. It suggests that over the long term, the company has not been able to generate enough profit to cover its expenses and grow its equity base. The acquisition of Devon Park Advisors is a clear strategic move to diversify their offerings and potentially tap into new revenue streams. It's an attempt to bolster their business in a challenging market. The decrease in clients and revenue is directly linked to the broader economic environment and the lulls in deal-making. They are definitely feeling the effects of a less active M&A market. Looking ahead, their ability to generate consistent revenue and manage their expenses will be key. The company is on a path to profitability for the 9-month period. which is a positive sign, but they have a long way to go to clear that accumulated deficit and ensure consistent growth. Alright, that is our breakdown of Perella Weinberg Partners' latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the acquisition will help them turn things around? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community discussion and insights. Thanks for watching, see you next time.